In today's video, I am going to be breaking down what is, in my opinion, the best BMO covered call ETFs that you can currently get. There's some pretty interesting ones, so let's get down and let's check these out. The first one is the BMO Covered Call Technology ETF, ZWT. This is actually a very new ETF and is actually quite interesting. Its dividend is somewhere in that 5.5% range right now, even though Yahoo doesn't show it because it doesn't have a year on the market just as of yet. The average volume is only 5,800 shares per day, so of course if you're going to be buying like 2,000, 3,000 shares, it might be a bit hard to get in and out of. However, this is giving you a monthly dividend and it follows the tech sector in the States, which is a pretty good sector to be in, maybe not right now or at least recently, but remember, whatever goes down, generally speaking, market-wide, will eventually go back up. So because of that, this seems pretty good right now because it's had a little bit of a dip recently. But all technology stocks have had that dip. The MER is also 0.71, so keep that in mind too. Of course, everything has had a dip when it comes to technology very recently. This has only been around this year or about a year so far. So this is still quite interesting. It's dipped back down to close to where it started about a year ago. So because of that, there could be a buying opportunity here. We really have to see what happens with interest rates, to be honest with you. And it pays a 13-cent dividend as well. And that dividend is paid out every single month. Now, the reason why I was mentioning that we have to watch interest rates is because, generally speaking, technology is more of a speculative type of sector, in which case that anytime interest rates rise, there could be a little bit of a sell-off when it comes to technology, but I don't think that's going to last very long, as long as the economy continues to grow in the United States. In Canada, that's a totally different subject. The top 10 holdings are very, very interesting. Obviously, we have Alphabet, number 1, which is Google. And then we have Microsoft, Facebook, Amazon, Apple, Nvidia. That is a very big name going into the future. Visa, MasterCard, those are also very big names going into the future in my opinion because everything's going to be purchased online. And guess what you use when you purchase stuff online? Yeah, credit cards. Anyways, PayPal had a very bad run recently, however, with their earnings, but I really do think that they could set themselves up well into the future. But PayPal is one of those companies that has been around for a while. They seem to be slightly innovating when it comes to crypto, but now with what the Canadian government's doing with paying with payment sites like PayPal and different things like banks, as well as with like GoFundMe, I personally would stay away from any of those payment platforms right now, because if Canada can do what they're currently trying to do, then the United States could also do that as well, and that could really spell disaster for a lot of these payment companies. ZWH, BMO US High Dividend Covered Call, is another fantastic ETF that BMO has. And with this one, what you are getting is a dividend of, or a yield I should say, of 6.12% over the past year. And you are paying again a 0.71% MER. 34,000 shares traded on average, so it's a pretty liquid ETF to get in and out of. Recently, it's had a little bit of a pullback. However, if we really put this line up to that low point and we start really measuring it down, it's actually bounced off of that trend line, which is actually quite interesting. If it continues to go higher, and of course within the top trend line as we see here, then it could be quite interesting to see what happens going into the future, because if we extend these lines out, if they continue to trade within that trend, then something's going to happen about a year from now. But again, it's really hard to judge when it comes to covered call ETFs of the entire market. The reason for that is because, of course, if the stock prices rise a lot, then of course, then their ETF price might just decline a bit, mainly because they're selling covered call options against their stocks, so keep that in mind. However, it does pay an 11-cent every single month dividend or yield, so because of that, it's a very interesting one for as an income supplement. Top 10 holdings are generally the top 10 dividend stocks on the stock market in the States. Some interesting names right now would be Chevron, which is the third biggest name, mainly because there is a massive amount of investment going into the oil mining stocks just because oil prices are through the roof. And we can blame that all to the governments again. It's so much easier just blaming everything on the government, but believe me, it's their fault. Next is ZWC, BMO High Dividend Covered Call ETF. This one has a 0.72% MER and of course a 7.2% yield. I really do like this one right now, considering that Canada just may be opening up, sort of, kind of, in a way. Its average volume is quite high at 200,000 shares traded every single day, so it's kind of liquid and very interesting because of the sector it's in, which is Canada. High dividend stocks, banks. Of course, before the whole dip in the market, it was doing quite terribly, mainly because this holds a lot of Canadian banks, and the Canadian banks were not doing so well before this drop. However, now they're doing extremely well, and so is this ETF. Why is that? Well, I personally believe that there was actually kind of a small recession happening in Canada before the whole virus that has happened, and there was actually not massive growth when it came to the banks or really Canada as an economy in general. And because of that, I'm really set to believe that this virus could actually spur a lot of growth in Canada if we just open up. It has recently lowered its yield to 10 cents a share every single month instead of 11 cents, but that's because, of course, the premiums on call options are lower in this sector, mainly because it is not as volatile. We also have to remember that the government of Canada has basically printed a ton of money. I was reading, I think it was a Pierre Pulliver article that apparently Canada is printing like $300 million a day of cash. Well, guess what? That cash has to go somewhere. It's not going to be all going outside of the country somewhere. That's all going to be inside the country. And of course, this is why we have inflation. But what happens when we have a lot of money printed? That money gets distributed out to people, not always, but some of that money will get distributed out to people who will then buy things, which will then go into the companies that are in this ETF. Get what I'm saying here? All of this money that is being printed by the government will eventually be in the hands of the people, like middle income people, in which case then gets spent back on the big businesses, in which case the big businesses make more money, and then because of that, they become even bigger. So really, all this money printing isn't to help the little guy, it's going to help the big guy. That's just generally how it works. And then money gets cheaper because there's so much of it, and of course, that's why inflation happens. And the top 10 holdings here are Enbridge, Royal Bank, CIBC, BCE, which is Bell, TELUS, Canadian National Railway. I'm going to stop right there. First off, where does money go? First off, it goes to the banks. The banks get it. Yeah, that's basically how it is. That's 100% what it is. I'm not going to sugarcoat this at all. Guess where businesses hold their money? They hold it in banks. They don't just say, well, here's my mattress in my office. I'm going to stick a couple of dollars under there. No. What happens is the government's going to be printing 300 and 400 whatever million dollars a day. That money's got to go somewhere. That money goes into the banks. Whether it goes to a business, to an individual, or to whoever, it goes to a bank. That bank is going to be, if it's in Canada, one of the big 6 banks. That's why I think that they're going to be making a ton of money, because now they're going to get this huge influx of money, and guess what? They can basically loan out 10 times the amount of money as what they have in their bank, which then means that they're going to make even more money. It's just how life works. The banks, especially in Canada with Trudeau as PM, are going to be making an absolute killing. And if you are not investing in the Canadian banks right now, you're missing out on this whole entire thing that Trudeau is currently trying to do. ZWK is another fantastic ETF. Again, still playing off of the whole entire idea of money printing. ZWK is a covered call ETF. Again, obviously this is the type of video that we are making, but this is the US bank, and the US has also printed an ungodly amount of money. And guess where that money goes? It goes to the banks. And guess where a lot of the Canadian money went to? It went to the US banks, because guess what? A lot of the businesses that do business in Canada are American. So some of that 400 and 300 whatever million dollars a day, a good percentage of it is also going down to the States to US banks. And because of that, Trudeau is now giving away money that we didn't have before, that he is just printing off, to American companies, because eventually that CERB money and all the other money will eventually funnel into big companies. And when that happens, some of those companies are Chinese companies, some of those companies are American companies, Italian companies, French companies, Canadian companies. This money is not just going to stick in Canada, it's going to go throughout the entire world. That's why the entire world is having a huge explosion of just inflation, because every government, they spent a ton of money or printed a ton of money, and because of this, that money doesn't just stay in the country. It doesn't just say, oh well, it's here. It goes throughout the entire world. That's why Trudeau can get away with saying that it's a worldwide problem while he's just adding to the worldwide problem. Now, before the whole downturn in the market, it was doing quite well. It was a fairly new ETF. Since then, it has exploded to the upside. It has also slightly leveled off. This could be an interesting time to get into this. I already own it from very, very long ago, back here and here and here. So because of that, obviously, do your own research. Don't just trust a random person online, because obviously somebody could be pushing this ETF. I am just trying to break it down. They have also lowered the dividend again in this ETF too, but that's because, of course, the premiums are also lower now in the same sector. The big companies in this ETF are, of course, Goldman Sachs, Bank of America. By the way, Bank of America historically has done extremely well. I've said this before, but has done extremely well when it comes to interest rates rising. They make more money when it comes to interest rates. It's not like a Canadian bank that just makes money out of thin air. And what I mean by out of thin air is just basically charging for literally everything that they do. And of course, BMO Europe high dividend covered call hedged to the Canadian dollar, because we want it to be hedged because we can't trust pretty much any currency at this point. But from here, close to a 7% yield, 44,000 shares traded every single day. Europe is also recovering too, which is interesting in my opinion. 0.71% MER. And Europe, just like Canada, was not doing very well before the virus. It was actually slightly recovering from its recent downturn when the whole virus hit. And since then, it's been slightly recovering, but this is Europe, and we have to really kind of look at it and say, will they recover? They were having some pretty massive issues here. What's going to happen into the future? We just have to see. Again, they also did lower their dividend too. They pay 10 cents per month per share. Its holding is the BMO High Dividend Covered Call ETF, which is ZWP, which holds Roche Holdings, Nestle. We've all heard of that. If you haven't heard of that, then you have not ate chocolate. And from there, overall, just fantastic companies. And the last one I'm going to break down is the Covered Call Canadian Banks, ZWB. This is 0.72 expense ratio, 5.3% dividend. I'm going to tell you right now that the banks generally pay around 4.5%. So for the extra 0.8%, you are not really worthwhile holding this. Now, I'm saying that this is a top ETF when it comes to the BMO covered calls just because of its raw volume. The volume is 180,000 shares traded on average every single day. I personally don't understand why anyone would even buy this ETF, but that's my own personal opinion. The reason being is you could just hold the individual stocks yourself, get a 4 to 4.5% dividend without having to pay an MER. Obviously, you're not going to be getting paid every single month, but at the same time, you're going to have a higher upside if the market rises when it comes to the banks, especially right now with, again, all this money printing. And the covered calls are, you would buy that when the markets are going either even or slightly down. And you're not going to be looking to buy a covered call ETF if the market is looking to jump massively. You'll still see the gain, but you're not going to have a massive gain as you would with the individual stocks. Anyways, that is my take on these ETFs. Hit that like button, subscribe if you agree or disagree, and let me know down in the comments your thoughts, and I'll see you guys again next time.